Hi everyone, welcome to Investing Club. In this video, I'm going to be talking about why I don't think it's a good idea to be investing in airline stocks and cruise stocks right now, such as Carnival Cruise Lines and Delta Airlines, and why I think investors who are buying into these stocks are falling into a classic value trap. Now, before we start the video, I am not a financial advisor and you should not consider this financial advice. You should always do your own research before investing or not investing in any stock. Now, in my last video, we got 84 likes, pretty good, but I think we can do better on this one. Let's shoot for 100 likes on this video. Now, let's get right into the video. So I think a lot of the cruise stocks and airline stocks are a classic value trap right now. And what is a value trap? A value trap is a stock that appears to be cheap based on either a ratio like the price to earnings or the price to book ratio, but what ends up happening is the price stays depressed at those levels even though it seems cheap. And when we take a look at a stock like Carnival Cruise Line, ticker CCL, we can see the PE ratio is a 5 and the price to book ratio is a 0.4, so under a 1. And so a lot of investors see these ratios and think, well, this is a very cheap stock compared to how it's usually valued, and therefore I should buy it. It will make a good investment. And in my opinion, I would really hold off on investing in these industries because I think they are full of risk right now. What I see a lot of people do is they see a stock fall 50% or 60% and then say, well, that stock is now 50% on sale. And I think this is the wrong way to look at it, because if you say a stock is 50% on sale after it falls 50%, what you're implying is that that stock was correctly valued at the previous high before the fall. And I think that is faulty reasoning, right? Because you have to be able to justify why the stock should be worth that amount. For example, at Carnival Cruise Line, this was a $50 stock at the beginning of this year, and now we are down at $14. And so to say that this stock is 70% off, I don't think that's really the case in this situation, because this is a vastly different company now than it was a few months ago. And so the stock market isn't completely efficient. I don't believe that. And that is how value investors make money, earn high returns in the stock market, by taking advantage of stocks that are mispriced. However, the stock market, I believe, is mostly efficient. If out of 100 stocks that fall 50%, maybe 99 of them deserve to fall 50%. Something happened to these companies that justified a price drop of 50%. And so the job of value investors is to look through all of these companies and find the one out of 100 that doesn't deserve to have fallen 50% before you invest in it. But the vast majority of companies that fall this much deserve to fall this much. And I'm not sure if these cruise lines and airline stocks are any exception to this rule. So we can take a look at some articles. And, out of all of the cruise lines, Norwegian Cruise Lines is burning between 110 and 150 million per month. And it has 2.4 billion in liquidity. Royal Caribbean is burning between 250 and 275 million a month in cash. And they have borrowed 3.3 billion. And Carnival has not disclosed its burn rate, but their burn rate is expected to be higher than Royal Caribbean's because they have a larger fleet of ships. So even though Carnival just raised $4 billion, it might not last as long as you think it will if they're burning north of $300 million. For example, Carnival raised $4 billion at an interest rate of 11.5%, and that is a pretty large interest rate to be paying such a large amount of $4 billion on. And what this loan is going to do is going to really hamper this company's ability to return to profitability once people start going on cruises again. These interest payments are going to take a big chunk of the earnings that this company brings in. And there's also an analyst that lowered his price target, and what they said was booking volume for these cruise ships is declining, and we don't really know when cruise ships are going to be back at full capacity. Carnival's rating was recently cut to a junk rating, which means now whenever they take on more debt, they're going to have to pay a higher interest rate for that debt. And here's a pretty concerning sign. This is a letter from one of the executives at Carnival, and what they say is they hope to bring back a small number of ships on August 1st, but it is still very uncertain. So that's at least 2 more months where there's not going to be any cruises. And again, Carnival is probably burning around $300 million a month every month that they're not sending out cruise ships. And so even that 2 months is still very uncertain. It could very well be an extended period of time longer than that. And that is risk that I'm not sure most investors realize they are taking on when investing in the stock. In addition, some big news last month was Warren Buffett sold out all of his airline stocks, including Delta Airlines and United Airlines. And what has happened as a result of this is airlines have not been able to receive the amount of financing they were expecting because of the impact of Warren Buffett basically giving up on airlines. So United Airlines had a $2.3 billion bond issue in place, which is them raising debt, but that ended up falling apart. And they think a big part of that was the result of Warren Buffett selling out all of his shares in airlines and basically saying, I don't know how the airline industry will come out of this. I think that is having a big impact on investors willing to take on debt of these companies. In addition, the Delta CEO says it could take 2 to 3 years for their business to fully recover. And what he says specifically is, we know that Delta will be a smaller airline for some time. And that really goes back to what Warren Buffett was saying in a shareholder meeting when he says that all of these airlines have way too many planes and now they're going to have this huge supply of planes but not demand for the planes to be used. So what's going to happen is they're going to have a lot of costs keeping these planes without actually having to fly them. Now I want to move on to fast graphs because I want to make a very important point about some of these companies. This is Carnival right now. The first thing I want to talk about is the dividend. The dividend has been cut. And a lot of people are buying into the stock saying, well, yeah, maybe for the rest of this year, there won't be a dividend. But once this business comes back, the dividend will keep being paid. And a lot of investors were in this company in the past for their larger dividend. But I want you to notice what happened in the 2008 recession. In 2008, Carnival Cruise Line paid out a dividend of $1.60. And after that, during the recession, they cut their dividend for a year. But what I want you to notice is when they brought the dividend back, it wasn't at $1.60. They brought a dividend of 40 cents back for the year of 2010. And even after that, this dividend was at $1, and it didn't go back to the $1.60 level until 2017. So if you bought this stock in 2008 expecting the dividend of $1.60, you didn't actually receive that for almost 10 years after. And I think a similar thing's going to happen now, where people are expecting the dividend to come back to the level it was, and I just don't see that happening. In addition, what some of these companies are doing to stay alive is they're diluting their shares. For example, Carnival Cruise Line diluted their shares by 40%, and that is a huge deal if you are a shareholder of this company. Because what dilution of shares means is that the earnings per share are now going to be 40% lower, even if they go back to their levels back in 2018 and 2019. So even if you are someone that firmly believes that the cruise industry will come back and this company will be generating as much earnings as they were last year, we can take a look. This company has historically traded at a PE ratio of around 17. A PE ratio of 17 would mean the stock would be $75, which the high of the stock was around $71. So even if you think that the earnings of this company are going to go back to that point, you have to realize that earnings per share will be 40% lower just because the shares have been diluted. So what would that mean? If you think that we are getting back to that level, this company would only be worth $45 a share. And again, that is assuming that we stay at the 17, assuming that this company will still be valued at a 17 PE ratio, which I do not think it will be very likely after this. And another thing to note is that this company is probably going to lose a ton of money this year. And even next year, at the end of 2021, a 17 PE ratio would mean this company is still at around $15, which is exactly where it is now. Which means for the next 2 years, you might not see much upside for the stock. A very slow recovery is expected. And again, for those people thinking that the stock is going to double or triple in a year, I don't think that has a high chance of happening. And we can also take a look at what happened with Delta after the 2008 recession. They didn't start paying a dividend until 2013. So that was almost 5 years after the recession that a company like Delta started paying the dividend again. So we could see, a lot of people invest in cruise lines and airlines, especially for the dividend, but I don't think a lot of people realize that the dividend might be suspended for a lot longer than they think. I think that will get a lot of people in trouble because they invested in these stocks just for the dividend, and they wouldn't like these stocks if there was no dividend payment. And so a lot of investors are going to be stuck. In addition, as I've said in previous videos, airline stocks have been doing a historic amount of share buybacks over the last 5 or 10 years. And this is what I think really pushed up the price of airlines. But now that's going to stop because airlines don't really have any money to do share buybacks anymore. So I think what we're going to see from that is a really lagging share price because these airlines don't have the cash to take advantage of such a low price that their share price is trading at right now. So I think the really big picture to take away from this is cruise line companies and airline companies are completely different than how they looked 2 or 3 months ago. For the example of Carnival Cruise Line, this went from a pretty strong company to a company that now has really loaded up their balance sheet with debt, has diluted their shares by 40%, and has no clear timeline for when they're going to be able to operate as a business again. And I think that the uncertainty for these companies is way too great for me to invest in. And I think this has the potential to be a huge value trap. Again, because I don't think that these stocks are trading at 50 or 60% off like everyone says they are. I think that these stocks fell for a good reason, and I'm not sure if they will make a fast recovery like a lot of people are expecting. Now, that being said, this is just my opinion. So if you own any of these stocks, leave a comment on why you think they'll recover, and I will definitely get back to you in the comments. So if you learned something from this video, hit the thumbs up button, subscribe to the channel if you haven't already. I post videos about the stock market multiple times a week, and I will see you all on the next video.